the more friction we could take out of the rental process for the renter, the easier we make it for them, the more transparent it is, the better the communication. Ultimately, the more of the satisfaction you'll probably derive from your renters.
I have a dream.
With great power comes great responsibility.
I could do this all day.
This is it. Don't get scared now.
They may take our lives, but they'll never take our freedom.
Cinderella's story out of nowhere.
It's in the hole. That the only thing we have to fear is fear itself.
Welcome back to Capital Hacking. John, thank you for joining me on the big show again, as always.
What a great show we have for you guys today. We have a guest, Jay Parsons from realpage.com.
Yeah, and RealPage is this kind of juggernaut of data. They're also in the world of asset management. And this is the guy who does the economic analysis on the industry. And, when we wanted to go out and get him to be on the show, we thought, why don't we bring some of his expertise of studying so much data on real estate rents, specifically single-family rental, multifamily, and he also studies BTR. And let's have him share the inside scoop on what's going on in the industry today.
Yeah, it's fantastic. And guys, if you're listening, definitely get some notes here because his company, realpage.com, not just supplies software to landlords, but they also supply the software to property management companies. So realpage.com has software that oversees more than 10 million rental units.
Which means when they're looking at data, it's like real data from their own 10 million units. Well, we pushed this fella. I loved him. He said he'd heard great things about our show and he had to get it vetted before he could be on it because he's a public company. So we pushed him and he shared 3 things that are what he believes to be the policy risks, meaning governmental control risks in the world of apartment investing and ownership these days. And he'll share those 3. So stay tuned. You'll want to know what the risks in our industry are. We also push him a little bit on price discovery because he talked a lot about how it's a frozen market right now. Not too many multifamily buildings trading, nowhere near the pace of last year, right?
Yeah, and he also gave us insight on what markets are kind of like are on the downward swing and what markets are on the upward swing. So you're going to want to pay attention to those locations in the country.
Yep. I think we're going to enjoy it. He's a great fella, new friend of Capital Hacking. He'll love it. He'll be back. And we hope you will enjoy the next episode.
Let's go.
It is a tremendous honor to have Mr. Jay Parsons with us, John. Jay, welcome to the big show.
Yeah.
Thank you. Thanks for having me.
Jay, thank you so much for joining us and giving us a little bit of your time. I know you're going to add tons of value to our listeners. Can you give us a backstory, who you are and where you came from?
Sure. So I'm a chief economist for RealPage. So we're a property management software company to the rental housing industry. And so I spent the last, now 14 years tracking rental housing market across the U.S. And in my role, we get access to lots of data. And that's the world I live in every day is tracking what's going on in the rental housing market across the country.
Yeah. So enjoy that. And I also enjoy, I know you're a great person down there in our lovely state of Texas. Is that where you grew up? Did you grow up in Texas?
Yeah, I moved around a little bit, spent some time in Texas, spent some time in the Southeast, went to school in Maryland, came back to Dallas, married a Texas girl. So now I'm here for good.
Any children?
Yeah, we have 5 children.
See, you're halfway to me, buddy. I'm a 10er.
Wow.
I got to 10. I know it's rare. 5's amazing, by the way. Congratulations.
Yeah.
What a perseverance.
We stopped at 3, so 5 is amazing, and 10 is over the top. Not
overachieving, buddy. We're all
jealous.
overachieving.
10's great. Yeah, I'm a big believer in the more the merrier. It's just math, it's just addition. So that's great.
It's just addition. By the way, isn't there something about it? It's easier too, right, Jay? People would never know that it gets a little bit more smooth after about 3 or 4, and then you have one because ages get old enough to help the littlest, and so there's enough span there to create, I call it surrogate parents, or become the bigs, the middles, and the littles. How old are yours, Jay?
That's true, and mine are range from almost 2 to age 10. But I'll tell you, there was a study done a few years ago. I forget where it was, but it was a survey of mothers trying to measure stress level based on number of kids, and stress peaked at 2 to 3 kids, and it goes down from there. I think it's for the reasons that you mentioned.
I have been saying this for years, but you got stats. I got to get those stats.
But also too, it's like when you have your fourth and fifth, and I guess the 10th kid, you start to realize, what really matters and what doesn't. When your first kid, it doesn't matter who you are, me, you, anybody, we all worry about all the dumb stuff, right? And the fourth and fifth kid, the 10th kid, whatever, you realize, all right, that doesn't matter. That doesn't matter. This does matter. I'll worry about this thing.
So Jay, what is your lovely wife's name?
Well adjusted, right?
It's true.
You're adjusted. Yes. And my wife's name is Holly.
So Holly, thank you for having all the children, Holly. As us dads always say, it's harder on the mom.
Yes.
Super easy on the dad to have kids, to make the babies. So thank you.
My wife would tell you the same thing though, in terms of the hardest one's the first one. So
yeah. Well, that is a nice thing for those out there having children. Do not be discouraged. It is challenging. It is a life-changing thing, but it's a blessing. All right. So Jay, RealPage, not everybody listening today knows the resources of RealPage and its business. Would you share a little more about that business as well?
Yeah, so RealPage has been around since the late 90s and really was one of the first big providers of a SaaS software as a service to the rental housing space. And so everything from kind of basic property management, keeping track of your rent rolls, who lives in the units, the billing and rent payments, to utility management and business intelligence tools. I mean, there's 60 plus things that we do at RealPage, both for property managers as well as for owners and even for renters. So we work with pretty much every stakeholder in the rental housing market.
Jay, so RealPage is software for landlords. That's correct, right?
Yeah, I mean, we use for the property managers, the owners, but also we do things for the renters as well, like renters insurance, rent reporting, rewards. I mean, we have a lot of direct to consumer things as well. But yes,
that's awesome. So you're a one-stop shop. What's the average customer of yours? Like, would it be a property management company? Would it be a mom and pop that has maybe 10, 20 rentals? What does that look like?
Yeah, so we service the entire universe. I mean, there's more than 10 or 12 million units that run on our platform of different pieces of the platform, I should say. A lot of it on the multifamily side, so much of multifamily, especially once you get outside of, places like New York City. For most of the country, most multifamily these days is professionally managed, larger apartment complexes. That's a big part of our business. But we also have a platform called Buildium for mom and pops, single family rental providers for the most part, and some larger. But so we service a pretty broad spectrum of the industry.
And may I just get that one more time? What was that? Buildium?
Buildium, yes.
Can you spell that for the listeners, please?
Sure, yeah. It's BUILDIUM. So like build and then IUM.
It's a great resource. Our listeners are a lot of self-made owners of, 1,000 plus. Let's say we have some listeners that are 1,000 plus units that they're involved with, either as partners or owners. And we're in that sector of high net worth kind of, acquisitions of properties, not institutional. So I just want to ask that question. Is RealPage driven by a lot of large institutional investors that need this resource, or do the groups like ours in the 1,000 unit level often use RealPage?
Oh yeah. No, I mean, bear in mind, y'all probably know this, but we service all of the above, but in the rental housing world, especially in small multifamily and in single family rental, the vast majority of the market is not institutional. And in fact, we go through this all the time. You see the headlines of what's going on in the single family rental market. And it's like, oh, these institutions are buying all these properties. Well, institutions are like less than 5% of SFR ownership. It's tiny. They just make all the headlines. And in small multifamily, it's the same way. And then even in larger multifamily, about institutional grade versus, is it an ownership may not actually be institutional.
I see.
So now we work with all different types. We work with institutional owners, work with mom and pops and everything in between.
And small multifamily means what in your definition? What's measurement of units?
Yeah, so there's no scientific definition, but generally when you think of a smaller multifamily, it means something does not have on-site property management. There's no front leasing office. It's off-site managed. Usually, like your walk-up buildings in New York, the phone number on the door, it's usually different from what we'd consider, on-site management.
So Jay, this is a fun question before we get into the work you're doing these days, and if you're going to kind of bring us all up to a whole nother level of education.
Okay.
What made you choose to go down this path after you got your degrees? You were passionate. Did you always have a passion for studying real estate economics, or Like, what's the natural course? How did you get into real estate economics?
Well, I think most people will tell you that, especially in multifamily real estate and single family rental real estate, most people get in there by accident and they stumble into it one way or the other. And I was the same way. I was mid-20s. I was getting engaged, needed a job, was going back to school, and took what was really a horrible job as a research analyst, writing really dry research reports on the quarterly apartment market conditions. And it's the kind of stuff now that you have, machine learning tools can write these kind of things for us. And so I had no real intent of staying around, but this was 2009. And when I started and fell in love with the industry, the company, so much was changing. It was kind of a coming of age story of rental housing.
Yeah.
And so, in hindsight, it was a blessing, and I'm thankful for what I get to do.
John, I got another fun question for you. So, Jay, in all these years of studying what's going on, and you've seen a really high run up over the last few years, I'd love for you to opine over what you've seen in the world for the last 10 years. But did you buy any? Do you own some rental properties today?
No, I mean, we still own our first home that we purchased, but other than that, no, I'm not a direct owner in real estate since we draw a line a little bit there.
That's good. Okay, well there you go. So Jay, tell us, if you don't mind, John, may I ask can you give us, our listeners, a snapshot? Some of our listeners have got into real estate during the bubble and the boom, I should say, of the last 10 years plus, the long running bull market, and maybe have had several wins, large successes, and have been boosted by both value-add strategies plus the economy. How should we all just understand the last 10 or 20 years? And then where are we going, if you don't mind a broad question like that?
Yeah, no, it's a great question. I think you think about rental housing, broadly, it's gone from a very kind of alternative, opportunistic asset class to increasingly a very mainstream primary asset class. And, you see that with the capital coming into the sector. And it's not just institutional. Again, they get all the headlines, but, it's really everything. I mean, now all these tools where, we call mom and pops, but really just, individual people and families and small investor groups, they could go online and use different tools that can help them identify and buy and properties. You hire somebody else to manage it if you're not there and able to do it yourself. And so a couple of things have happened. I think, first of all, there's been more kind of visibility into the space because of technology. You have all this data that flows around, companies like ours. Obviously, we're not the only ones, but also, things like Zillow, where all of a sudden you have all this data at your fingertips and all these, online bidding tools and whatnot. But also, there's been a growing demand, obviously, for rental housing. The macro story for rental housing has been very favorable. And by the way, it's happening at the same time the homeownership rate's gone up, but there's still been growing demand for rentals as well. And so there's kind of this, it's a both and story, not either or, but it's highlighted the need for rental housing. And that really started coming out of the great financial crisis when you had foreclosures, and it led to this big rush of demand for single family rental properties, both among renters who all of a sudden needed a place to live because they were no longer in a home they owned, as well as investors who saw prices drop by double digits and started to see opportunity to buy. And again, it wasn't institutions that got all the credit, but it was a lot of individuals who were being very opportunistic at the time that really helped kind of start that cycle back then. So you fast forward a little bit, these last, since 2010, it's been pretty much a pretty steady upmarket until you got to COVID. And then through COVID, it was everyone kind of feared the worst. I hear all these headlines about eviction tsunamis and whatnot. Never happened. Renters paid their rent by and large for the most part. We track rent collections and never went down very much at all. And where it did, it tended to be very concentrated in certain pockets. And then we had these boom times, and then, it started to really slow down. And so I think now we're entering this market where past few years, you could have had the worst strategy, been the worst operator, and still, rising tide boosts all ships, did pretty well. I think, going to where we are now, I think the market's really shifted. And now I think you're going to see much more divergent performances from investors based on, where they are, how they're operating, and everything else. So it's becoming a much more strategic market right now.
Yeah, that's a good place to be at the moment. Where have you seen, like, let's say over the last 6 to 12 months as rates have continued to go up, have you seen a lot of investors kind of go to the sidelines and hold cash, or have you constantly seen investors going in as hard as we've been?
Yeah, it's interesting. It's we've never really seen anything like this, at least in my time, where it's both on the fundamental side, where there's all this great job growth and yet so little demand for housing right now, but then on the investor side, where there's a ton of pent up demand to to acquire multifamily and SFR, but the sellers are not, well, the owners are not in a position to be sellers for the most part. I mean, with the cost of debt going up as it has, these deals just aren't penciling out unless there's something really unique or, some pockets of distress, things like that. And so it's not that buyers have necessarily gone away. It's just that I talk to people all over the country, different sizes. Everyone wants to be a buyer. They say they have capital. There's a lot of so-called dry powder out there from, the mom and pop level up to the institutional level. But, I think there's kind of a wait and see and a kind of a stare down contest right now between sellers and buyers. And with rates going up, it's not just that they've gone up. It's that they've gone up as fast as they have.
Correct.
That's kind of taken out predictability and created, thrown a real curveball into the market. And so it's we're in a kind of a holding pattern right now.
What markets are you seeing? Because you got the software over 10 million, whatever, 12 million. What markets are you seeing that are hot right now? Like that are still, investors are still charging forward with the single family and the multis?
Well, it's slowed from an acquisition side. It's slowed down everywhere because as the cap rates and interest rates, cost of debt. I mean, it's the same. Yeah, I mean, the variability is pretty tight, right? You can't, sellers can't get a 4 cap deals they need to make deals work, and buyers can't get the 5 to 6 cap rate deals they need to make their side work. So, but from a operational side, we're still seeing stronger performances in places like Florida, the Southeast, parts of Texas. There's still, I think, better demand in those spots. And even New York City, by the way. New York City obviously got hit really hard during COVID, but come back very strong. Conversely, San Francisco has been the opposite. That's been consistently struggling. And so, I think investors have sort of followed the same pattern. We've seen more capital coming into the Sun Belt over the last few years and away from especially California, but also some of the other coastal markets. By the way, also some struggling spots. Phoenix and Vegas are kind of exceptions to the Sun Belt rule. They've really slowed down quite a bit.
Well, and this is just, we're going to push to see how much different data you're keeping track of in your mind right now. Are you also keeping track? I know you're keeping track primarily of the rental rates, correct? I mean, is that the salient point, and the occupancy or that lack thereof? Or do you also cover a lot of the construction cost if things were being developed today?
Yeah, we look at we don't specifically track construction costs, but obviously we hear about it. And so, in fact, one of the questions I get all the time is, hey, there's all this construction. Why? I mean, we're building the most in multifamily that we have in 40 years, almost 50 years. But why is it all, so-called luxury, Class A plus? And that's, to your point, it's construction costs. I mean, I think a lot of people don't realize that, land, labor, materials cost the same, whether you're building, luxury or workforce housing. And so,
that's a great
the construction costs have gone through the roof. I mean, everything's expensive right now. Inflation impacts construction too. And so it's been a major factor. Plus now, of course, you have higher rates as well. So we're going to see significantly fewer new starts this year than we saw the last couple of years.
So a rule of thumb, people, they're enjoying this show. A lot of times this show is we keep it light. We keep it light, Jay. It's a podcast. So they're treadmilling, they're driving. If they're Tesla, if they're Tesla owners, which I'm not that fancy, they're not even driving. The cars do it. So my point is, can you give us a rule of thumb as to what you've heard or where you see prices going for units and for rents? Let's just choose a market. In the Sun Belt, perhaps the most recent market you studied, whatever that was. Can you share what you've heard and what you see the trend is on unit value, whether it be build or buy, and rent value and where it's at? Is it stable? Is it going up, going down?
Yeah, that's a good question. I think, I think we're at a point now where there's very few exceptions. Like it's a pretty much a national story with some extremes. Like again, like San Francisco is going to hit harder than, Dallas where I am. But for the most part, there's very few outliers. And the outliers that do exist are kind of like oil markets like Midland, Odessa, and Williston, North Dakota, which are very counter-cyclical and still kind of booming right now. But for the most part, the story has been decelerating rent growth. And so obviously we saw a huge rent growth 2021, first part of 2022. And since then, it's decelerated pretty quickly. We saw month over month rent were negative the last 4 months of 2022. It was flat first part of 2023. And so you get into asset values. I mean, it's hard to even say because I'll tell you, the apartment trades were the slowest in January for any month they've been since January of 2011. So the market's just froze. And so I think we're still in a price discovery phase where everybody knows that asset values are down to some degree, but the sellers don't necessarily want to sell to that.
Right.
So it's more of an on paper value versus a real value and what buyers are willing to buy for. So I don't think we yet have a clear answer. We probably won't until, I don't know, maybe summer time frame when we start to see a little more, at some point, I think we're going to see somebody start to jump.
That's a good question for you in particular. And maybe the answer is you're not sure, but like I have in my unit seen a slowdown and vacancies going on right now, which is completely unusual. And because it's been people beating down your doors. When do you think that uptick is going to come? Like, what are your thoughts there?
Well, yeah, I mean, I'll tell you first, let me just preface it by saying that the crystal ball is definitely fuzzy. So I don't claim to have, perfect knowledge of what's going to happen in the future. But, I think here's how I think about it is last year we saw a year like none other. We had really, outside of the initial COVID bounce back, you had the best job growth that we've seen in 30 plus years. You had really strong wage growth, even if it didn't completely keep pace with inflation. Still, you had tremendous wage growth. So typically job growth and wage growth equals a lot of housing demand, and that's a lot of traffic, people knocking down your doors. But that really stopped in the second half of last year in most parts of the country. And so I think we're at a point now where, obviously the question is, when does it return? Well, to try to give you at least my view on how this plays out, I think there's a lot of pent up demand in the market right now. I think inflation, everybody talks about the rents, but it's really just more broadly inflation. The cost of groceries is up 13% year over year. And that impacts everybody. You go to the grocery store once a week, wherever you get your groceries, and everybody sees that check all the time. It gets in your head, the price of gas, other things like that. And then all these negative headlines. And so consumer confidence went way down last year. So my view is people got nervous and they thought, hey, you know what? Instead of going out and getting our own place, we're going to wait it out for a period. We're going to kind of see what happens. Even if we got a job, we're getting paid well, we have the money, but let's just wait it out. And so if inflation continues to cool off, and there's some early signs that it has, and if consumer confidence improves, and again, there's some early signs that it might be according to the University of Michigan survey, then I do think by the time we get to the traditional leasing season, which is, spring months, so, late March, April, May, I think we should see demand bounce back. And I don't think it'll be crazy like it was, 2021 timeframe. But if I had to kind of get pinned down to make a guess, I think it's going to look more like, pre-COVID normal.
Jay, we're sitting here and we know how much work you do in analysis. And as typically most of the people we have on the show are entrepreneurs. So it's kind of a nice shift of gears. People are out there listening. They're like, I like this guy. He's teaching us things we don't talk about every day.
Yeah.
Tell us more what we're not asking you that you could just share in your last few years or in the last few months. You're like, these are things I'm thinking about, Jay Parsons at RealPage. Here's what we're working on. Public knowledge. I'm not talking about private knowledge. What are some of the research and the work you guys are working on now?
Yeah, I'll tell you, I think, with all of the changes and the growth of the rental housing sector and certainly the increased presence of the institutional market, like there's more of a spotlight on the sector. And so I think kind of the biggest challenge going forward that a lot of investors are thinking through is, policy risk and also, just general kind of risk management. And so I'll take that from a few different angles. Number one is, those who are not directly involved in the industry day to day would be shocked at how much leasing fraud is occurring right now. There are basically, little entrepreneurs, you got to call them that, who create kits for how to create a fraudulent lease application and never have to pay rent, where basically you're buying a package of what they call a synthetic ID. So it's, real social security number, real names, real address, a phone number to verify employment, pay stubs, but it's a composite of different characters and some things that are real, some things that are not.
Wow.
And so each thing sort of passes a test, but together, they may not. And then, they can move into the property under a fake name and you have no idea who this person really is.
Oh my, whoa, time out. This to me is earth shattering. I've
never heard of this.
So you're saying Bill the real guy's name is Bill, but on the paper, it's an identity that he bought. And
yeah.
It's Sam. And Sam's identity is real in a way. So when we vet Sam, he has a credit report, he has a job, a soch, but Bill's the guy who shows up and moves in. We never know that.
Yeah.
And then Bill never pays a bill, is what you're saying.
Right. Right. So what's happening is it's like for a technology company. So it's changing how we think about screening. We have to make sure that it's not just a traditional background check, but you have to verify that this person is who they say they are. And all of these pieces are to the same person. So, I tell people now, it's like, look, like, you really, that's one area you don't want to go, cheap is in how you look at, identity verification. That's a very big, risk, especially for smaller owners that, if you have 4 or 5 rentals, one is 25% of your entire
That's right.
revenue or, thereabouts. So it's a real concern.
Well said.
That, in fact, I mean, people who are listening, you can go online and, look at Facebook, you can Google it. I mean, it's TikTok videos on this. You'd be very surprised how easy it is to find this information and frankly do this. And by the way, I want to also make this point. It's like, I don't think our policymakers fully understand the implications of these challenges, because everyone's like, who cares about the landlords? But what's happening is when these people get through, the people who really lose out in a tight vacancy market are other renters who are honest, need a place to live. Or imagine if you're living in a property like a duplex or an apartment property where your neighbor is not who they say they are. You have no idea who that person is, and they've not been through a proper background screening. Like that's a risk to renters as well. And so it's a big deal.
Now, I interrupted you, John. I interrupted him. I think you said there were 3 things. One was leasing fraud. What were some of the other things you guys are working on right now?
I think another thing, I don't say I'm necessarily working on it, but I mentioned like policy risk. And so talking to investors now, versus, when I joined the industry in 2009, it's coming out of the great financial crisis. I mean, you already remember this. A lot of the kind of key initial real estate investment theses of that era were, hey, you got to be core. You want to be coastal markets, downtown, Class A. Like that was obviously institutional theory, but also I think more broadly, that was kind of viewed as what you're supposed to do. And I'll tell you, it's dramatically shifted where we've seen, a lot of investors who are, dealing with different policy risk issues, and in places like California and obviously New York, where you have things like the good cause eviction bill, which is, a misleading name, as you all know. And that's creating more, I think, less interest in being in these types of markets, and this is driving more interest into the Midwest and into the Sun Belt.
That's a really good point.
A big exodus in the state of New Jersey, Josh. I'm sure you've seen that, landlords wanting to get out because it's very unfavorable for landlords in that state. You were talking about, I just wanted to come back. I had a few questions here. What are the ramifications you're seeing for somebody committing leasing fraud?
Well, I mean, as far as I know, there could be exceptions. I think they're remarkably low. No one's really going after you, but the problem is that, even once the landlord realizes they need what's happening to pursue an eviction, and even if you can legally pursue the eviction, it's going to take months for that to play out. And this is, again, kind of the policy risk factor. I think a lot of people, and this is something I feel very passionate about. It's like, I think what a lot of the broader world doesn't realize is that most people, even landlords, they want to help people who are truly in need of help and like figure out a bridge solution. But unfortunately, you also have at least a small contingent that's committing fraud of different sorts out there. And those are people that you want to get out right away.
Exactly.
There's no common sense applied to these rules. And so, unfortunately, we're squandering resources in some cases for those who don't really need it at the expense of those who do.
Wow. And then you also talked about decelerating rental income. What are you seeing percentage-wise on that? Like, so for example, if you have a good tenant, and normally you'd raise rent, 3 to 5% a year. Would you just keep rent the same? What percentage are you seeing when landlords are trying to either increase, or how are they decreasing it?
No, it's changing really fast. And so, what happened, just to give you a quick history here, is back in 2021, as we saw this big new lease rent increase, the front door rent. And then so 2022, all of a sudden you had this, what we call loss to lease, that was really big, which is the discount between what someone currently pays versus what someone coming in the door would pay for the same unit or the same type of unit. And so we saw these, more larger renewal increases than usual. Now we're at a point where that gap is shrinking again, but more importantly, demand has gone down, vacancies are going up, there's more supply in the market. And so the property managers that we talk to, they are very focused, you're always focused on this, but I think more than ever, very focused on retention and, limiting turnover. So because of that, we're seeing in some cases even flat renewal increases, or at least, something more in the, low single digits as opposed to what would have been in the upper single digits or even 10% in the past. And so it's really changed significantly.
Yeah, I can imagine that landlords and property management groups are really putting a lot of money into the customer service, and that may have lacked in the past too.
Oh, you're right. Yeah. And this is another big area of focus, which is part technology and part people service, which is just, I heard someone say once, the head of a property management company, he told me something that always stuck with me. He said that, my company, he's talking about himself as property management company. My competition is not another property management company. It's Greystar. I mean, it's not Greystar, the big property management company. He's saying it's Tesla, it's Amazon. It's these companies that have automated really good customer service where it's on demand, instant satisfaction, where I can quickly solve my problem. That's what consumers today want, and they're sort of expecting the same thing. If they have a maintenance request, they don't want to wait till you call them back. They want to have it filed, and they want to track the progress of that request. And so it's that type of stuff where, the more friction we could take out of the rental process for the renter, the easier we make it for them, the more transparent it is, the better the communication, ultimately the more of the satisfaction you'll probably derive from your renters.
And, John, great questions. Thank you for helping me understand those things better in the fraud in the process. I bet you there is a third probably. There is probably a third layer to policy risk, and it's the one I've actually talked about for a long time because I'm not core. My core business right now is not multifamily apartment. It's lifestyle hospitality where we sell a lot of weddings and corporation events. So different model. I've always wondered if with the last few years of double-digit rent increases, if policymakers would start to create versions of rent control or some type of prohibitions on these rents or evictions. And I thought that might be the third thing you were going to say, but maybe I jumped the gun.
I kind of lumped it with one of the others, Alex. But rent control, but I think, untargeted. Rent controls and eviction moratoria are sort of the same thing, which is that they were created as sort of emergency solutions. Like look at, New York City in World War I created rent control as a temporary solution. And, the Band-Aid turned into a long-term Band-Aid. And eviction moratoria was a short-term solution. They get extended and extended, even with unemployment at 50-year lows and job growth at 30-year highs. And so the reasons for it sort of evolved. And so, and again, I think the problem that, I'm of the view of, I think there's always these hard one side or the other. One thing I just don't understand is just common sense. Like, hey, let's get aid to those who need it and stop squandering it on those who don't. But these programs tend to be very untargeted. There's been studies showing in New York City, for instance, that the primary beneficiaries of rent control and rent stabilization have been upper income renters who don't necessarily need the benefit. And, there's a famous story about the former mayor, Ed Koch, who maintained $475 a month apartment in Greenwich Village while he was mayor. And, it's like, let's help those who really need it. And I think that's kind of the policy factor right now. This is not getting enough discussion, is everybody's talking about these blanket Band-Aids that turn into, longer term things. And there's this isn't, I'm not saying anything like necessarily, this isn't my opinion. There's been research after research, surveys showing 98% of economists don't think it works, and it backfires on the ultimate cause of affordability. It hurts those who are trying to come into the market. It makes it more expensive for those who are new. It makes maintenance and upkeep harder for the property as well to fund those things. So, I'll give it one last thing. Like in Orlando, they commissioned a study saying that rent control would actually be a bad policy, and the city council voted anyway to go ahead and put it on the ballot and do it. And ultimately, the state overrode it. But it's just a lack of common sense. Like, hey, let's just get aid to those who need it. Like that, I don't think it should be that complicated.
May I follow up on a comment earlier? Is about you talked about the demand for rooms or rentals is stabilizing or perhaps flattening in most markets. How does that jive with another common statistic we hear, and we hear it in mega numbers as far as the need for affordable rental housing and the supply of affordable housing, and how the gap is growing, meaning that there's even more pressure in the future. There would be more scarcity in the future. Are you of that opinion? And what is the numbers show? Is there actually a gap between how much is in need right now and how much is available right now?
Yeah, in terms of the perennial question around oversupply and undersupply, yeah. So, there's been various studies kind of showing, was it, 3 million, 4 million, 7 million. I think that the number is significant, but, you look at supply of anything, supply is shaped by, what economists would call price elasticity. Remember Econ 101. And so the cheaper the price, the more demand there is of something. And so it's kind of there's no specific number, but I do believe we're undersupplied. But I think the challenge that we face is that most of the undersupply is at the lower price points.
Correct.
And we just cannot build at those lower price points without subsidies. So I'm a huge advocate for the low-income housing tax credit and other programs that help incentivize true affordable housing construction. By the way, talk about rent control. Last comment on this I'll make to you is like, a lot of people understand it's like, if you like rent control, you should love the low income housing tax credit because it's very targeted rent control to the renters who actually need it. And it doesn't have all the negative consequences and side effects of untargeted rent controls. And so, and there's buy-in from the owner and developer as well. So it's truly a win-win-win when we do it right.
Jay Parsons, you are solving the country's problems with that solution. I love it. I hope some local politicians are listening and can change some policies. So a question that I have here, since we're seeing, rental demand slow down and more competition among landlords and, property management companies, how do they separate themselves? So how do certain property management companies always keep their apartments filled and others don't?
Yeah, that's a good question. I think there's any magic bullet there, but it's, one thing I would say is that you need to take a holistic approach to it. I mean, for example, it's like just, price is obviously important. And so if you're trying to really hold on to a price not realistic, you need to adjust the price. At the same time, sometimes you cut the price half and half, and you're still not going to get demand if you're not doing other things right. If you don't have a good reputation, if there's all this stuff online about how you don't, how there's, crime and there's trash in your property, you need to address those things. If you're not responsive to your customers, or if you have a lot of friction, if you're still requiring, renters to use paper checks and you're and make a phone call every time they have a maintenance request, they're going to get a better experience. And so I think first and foremost is you want to figure out how do renters think about, or what's my reputation? How can I fix the experience? And then, obviously pricing and marketing are part of it as well. So there's no one magic bullet, but, certainly just making sure you're looking at it comprehensively is important though.
I'll tell you, it's been great getting to know you, Jay. And as we wrap here today, may we ask you to share a little bit more about how we can follow what you do with the company or what the company does so that our listeners can stay in touch?
Sure. Well, I post multiple times a week on LinkedIn and Twitter. So, of course, would be grateful every day, anybody who wants to follow, we put out there. But also our whole team of analysts and economists, we have maintained a blog at realpage.com/analytics. And there's a lot of good content there as well.
Thank you. That was awesome information today. I know our listeners definitely have gained some great tangible stuff that they can put into practice right away.
Thank you,
Awesome.
Jay.
Well, thanks for having me.
Cheers.
Damn straight. We just got
buddy.
We got to the end of another great show. And everyone listening right now, you're the family and friends. Thanks for staying till the end.
That was so fun. And hey, hit the like, hit subscribe. We're here to serve you guys. That's why we're doing this show. Josh is not paying me. I'm doing this off of my quote unquote sweat equity because we want to make a difference in your life. And then that ripple effect will continue to touch the world.
Hey, amen, brother. Please check us out on capitalhacking.com, all the social media threads. And yes, I know you've probably already sent this episode to one of your best friends. Thank you. We love you. Just go right into your iPhone, hit the plus symbol. We'll talk to you later. See you next week.
Share.